So on April 1st, 2026, I mean, if you looked at the S&P 500, it had one of its absolute best days of the entire year.
Oh, yeah, a massive day.
Right. Like if you opened your brokerage app, it was just a complete sea of green everywhere.
Yeah.
But if you were to look just a millimeter beneath the surface of that huge rally, you would find that 76% of those companies are actively drowning.
Yep. It's a fascinating paradox, really.
It is. So, welcome to the deep dive. Today, we are opening up a massive stack of institutional data to look at a global economy that has, frankly, literally split into two colliding realities.
Completely split.
Yeah.
Because, usually when we look at the global financial landscape, we expect to see a single interconnected map.
Right, like everything affects everything else.
Exactly. But right now, we're dealing with two completely distinct worlds operating simultaneously.
Yeah.
And they are aggressively rubbing up against each other.
Yeah. On one side, we have this old world economy, and honestly, it feels like it's dragging us by the collar right back to the 1970s.
Oh, absolutely. Stagflation, tariffs.
Exactly. Massive supply chain tariffs, and of course, a 5-week-long geopolitical conflict in the Middle East that is just severely disrupting global energy.
Yeah, it's a mess.
But then, completely superimposed over that, you have this new world reality.
Which is this insane capital supercycle driven by artificial intelligence and space technology.
That's wild.
It really is. I mean, private companies are abandoning traditional markets entirely, and they're operating with the budgets and the ambitions of sovereign nations.
Right. So our mission today is to help you make sense of this collision. We've brought together institutional bank analyses, geopolitical briefings, transcripts from the latest Federal Reserve press conferences, and some, frankly, mind-bending tech sector funding reports.
Because the friction between that old world and the new world is creating just unprecedented volatility.
Yeah, and whether you are actively managing a retirement portfolio, or maybe you're trying to navigate this really weird job market right now, or you're just insanely curious about how the machinery of the world actually works, these two realities are dictating your daily life.
They absolutely are. And if we want to understand where things are actually heading, we have to strip back the surface-level headlines to understand the structural forces underneath.
So let's start with those headlines. Let's talk about that April 1st rally, because it was an explosive V-shaped relief rally across the board.
Yeah.
The NASDAQ surged 3.8%. The S&P 500 jumped 2.9%, and this was like a global phenomenon. Over in Asia, the market saw their biggest single-day rally in a year.
Right. The Kospi in South Korea was up 8.1%.
Yeah. And Japan's Nikkei climbed 4.5%. So what was the trigger? Like, what made the entire globe suddenly start buying all at once?
Well, it was a very sudden shift in the geopolitical winds regarding the second Iran war.
Okay.
The markets have been totally paralyzed by the conflict. But then President Trump announced that the U.S. could potentially leave the conflict in 2 to 3 weeks, basically indicating the initial military goals had largely been met.
Right.
And almost concurrently, reports emerged that Iran's president was showing a willingness to negotiate an end to the conflict, provided certain guarantees against further attacks were put in place.
And when you have that kind of diplomatic off-ramp presented, it immediately deflates the geopolitical risk premium that was baked into the energy markets.
Exactly.
Because Brent crude oil, which is the global benchmark, it had spiked up to, what, $119 a barrel at the height of the conflict?
Yeah, 1 in 19. And on this news, it dropped back down to around 105.
Which is a huge breather.
It is a significant breather.
Yeah.
Plus, we're seeing other global powers step in to try and build a floor under the region's stability. Like China and Pakistan put forward a 5-point initiative.
Oh, right. I read about that.
Yeah, their primary goal is securing the Strait of Hormuz. That specific choke point is critical because roughly 20% of the world's oil and liquefied natural gas passes through it.
20%? That is wild.
Right. So the market's absolute worst-case scenario over the past 5 weeks was a prolonged closure of that strait. The mere hint of a resolution, whether it's facilitated by Washington or Beijing, was enough to trigger that massive buying frenzy.
Okay, let's unpack this. Because to me, looking at the data we have, this market reaction feels a lot like taking a very heavy painkiller for a severely broken leg.
That's a good way to put it.
Right. Like, sure, the pain is magically gone for the afternoon. You feel fantastic. Maybe you even go for a jog. But underneath the skin, that bone is still snapped in two.
Exactly.
So is this a genuine structural recovery we're seeing in the public markets, or is this just a sugar rush driven by diplomatic headlines?
Well, what's fascinating here is if we rely on the technical analysis in our sources,
Yeah.
this is classic dead cat bounce territory.
A dead cat bounce.
Yeah.
That is such a morbid phrase, but
Yeah.
essentially it means a temporary recovery in a market that's otherwise in a sustained decline, right?
Exactly. Professional analysts are not viewing this as a genuine recovery at all
Why are they so sure this isn't real money entering the market?
because of the actual mechanics of how the rally happened. The data suggests this surge was heavily driven by something called short covering.
Okay, walk us through how short covering actually works mechanically.
Sure. So imagine you are an investor who firmly believes a stock is going to drop. You borrow shares of that stock from someone else and immediately sell them.
Okay.
You're hoping to buy them back later at a much lower price, return the borrowed shares, and pocket the difference. That's called shorting.
Right, you're betting against the company.
Exactly. But suddenly, the diplomatic headlines hit,
Yeah.
and the market shoots up. Now you are losing money fast.
Oh, because the price is going up and you have to buy them back.
Right. You panic, so you rush out to buy those shares back at a higher price just to stop the bleeding and cover your position.
Oh.
When thousands of traders do this at once, it creates this massive wave of buying. But it's artificial. It is driven by fear and damage control, not by new investors confidently deploying long-term capital.
That makes perfect sense. And you can actually see the lack of broad confidence when you look at the market breadth.
Oh, the breath is terrible.
It really is. When I looked at the percentage of stocks actually participating in the rally, it was shocking. As of the close of the first quarter, only 24% of S&P 500 stocks were trading above their 50-day moving average.
That is the telling metric right there. It means this massive headline rally was carried by a tiny handful of mega-cap tech and energy stocks.
Just a few big winners pulling the whole index up.
Exactly. The vast majority, the other 76% of the S&P 500, is still fundamentally struggling.
So the index looks like it's soaring, but 3/4 of the actual companies are sinking.
Yep.
And if you zoom out from the daily chart and look at the 3-month charts, the technicals are flashing bright red warning signs.
They really are.
The analysts mention specific candlestick patterns, like a bearish engulfing pattern for the S&P and NASDAQ and a shooting star for the Dow. For someone who doesn't stare at trading screens all day, what are those patterns actually telling us about investor psychology?
Well, candlestick patterns are basically visual representations of the war between buyers and sellers. A bearish engulfing pattern happens when the downward momentum of the selling pressure completely swallows the upward gains of the previous period.
So it literally looks like a giant red bar eating a smaller green bar on the chart.
Exactly. Sellers have utterly overwhelmed buyers.
And the shooting star.
The shooting star signals that buyers tried to push the price up to a new high during the trading session, but sellers immediately stepped in and aggressively swatted it back down.
Wow, just rejected entirely.
Yeah, it indicates that a prevailing uptrend has completely lost its momentum and a reversal downward is likely imminent. Unless the S&P 500 can decisively break through its critical resistance level of 6,730, the broader macro picture points to a deterioration. The painkiller is wearing off, to use your analogy, and the market is about to realize the leg is still broken.
Which brings us to the obvious question, why? Why is the market so structurally fragile despite the fact that we might be avoiding a worst-case scenario in the Middle East?
Right.
And looking at the Federal Reserve transcripts in our stack, the answer is that the underlying real-world economy is completely stuck in the mud.
The real economy is where the friction of the old world is most visible. I mean, even with crude dropping to $105 a barrel, the inflation chapter of this oil shock has already been written into the supply chain.
Yeah, we are still seeing gas prices across the U.S. sitting comfortably over $4 a gallon.
Yep.
And that energy spike is compounding a problem the Federal Reserve was already struggling with, which is sticky inflation.
Exactly. At his recent Harvard University address and during the March FOMC meeting, Fed Chair Jerome Powell noted that they have maintained the target interest rate at 3.50 to 3.75%.
Right.
They are trapped by inflation. He specifically referenced core PCE sitting at 3.0% with headline inflation at 2.8%.
Let's define that, because we hear PCE thrown around on financial news all the time. What is core PCE, and why does the Fed care about it more than the standard inflation numbers?
Well, PCE stands for personal consumption expenditures. The Fed prefers the core PCE metric because it intentionally strips out the things that swing wildly from month to month.
Like gas and groceries.
Exactly, specifically food and energy prices. The Fed's logic is, we cannot control the global price of eggs or a barrel of oil with domestic interest rates, so let's look at the underlying trend of everything else.
Okay.
And what that 3.0% number tells them is that the underlying trend of inflation is stubbornly entrenched.
And a huge driver of that entrenchment is the chaotic tariff environment.
Oh, absolutely.
Because the administration's original tariffs were struck down by the Supreme Court, new ones are being drafted, and all that uncertainty and extra cost is passing straight through the manufacturing sector to the consumer.
It is.
Our sources point to the ISM Manufacturing Prices Paid Index, which tracks what businesses actually have to pay for raw materials. It just surged to 78.3%.
That is the highest level we've seen since the massive post-pandemic inflation spikes of 2022.
Wow.
Yeah. And to put that in perspective, when raw materials cost that much, businesses basically have two choices: pass the cost to the consumer, which causes inflation,
Right.
or eat the cost, which destroys their profit margins. Usually they do a bit of both. But what they definitely stopped doing is hiring new workers.
Which brings us to the labor data. Because the February JOLTS report, the Job Openings and Labor Turnover Survey, showed that net hiring in the U.S. was a dismal negative 122,000.
Yeah, negative hiring.
Now, I know some listeners might look at the upcoming March ADP private payroll estimate of positive 62,000 jobs and think, oh, look, things are bouncing back into positive territory.
Right, but the sources make a point of dismantling that number.
They do, because it's heavily distorted.
Very distorted. That positive 62,000 includes roughly 30,000 Kaiser Permanente healthcare workers who are simply returning to payrolls after a strike.
So it's not new jobs, it's just a one-time mechanical adjustment.
Exactly.
Yeah.
When you strip those workers out, underlying private hiring is incredibly weak.
So what does this all mean? It introduces a concept that I think perfectly captures what it feels like to be a normal person in this economy right now,
Yeah.
the low-fire economy.
Yes.
I picture it like a bizarre game of musical chairs. The music has abruptly stopped, but instead of everyone scrambling frantically to find an empty seat, all the companies and all the workers are just standing perfectly still.
Just frozen.
Absolutely terrified to make a sudden movement. Companies aren't doing mass layoffs because it's too expensive to rehire later, but they refuse to bring anyone new on board.
It creates a holding pattern. And if we extend your musical chairs analogy, because no one is moving, no one is getting a promotion, and no one is getting a significant raise, their wages are totally stagnant.
Right. And this is where I have to push back on the official narrative. Because Chair Powell keeps describing the economy as expanding at a solid pace.
He does.
But if you haven't gotten a raise and gas is $4 a gallon, you stop spending. Look at the consumer discretionary sector. It's getting hammered.
Yeah, look at Nike.
Exactly. Nike shares just sank 15%, largely on a projected 20% drop in their China sales, and muted forward guidance. I mean, people do not buy $150 sneakers when their grocery bill goes up 20%.
No, they don't.
That does not sound like a solid economy to me.
This raises an important question, though, because that is the nightmare scenario for any central bank. It's called stagflation.
The simultaneous occurrence of stagnant economic growth and high inflation.
Precisely. The inflation tax of energy prices and supply chain tariffs is directly functioning as a wealth transfer away from the consumer.
So the Fed is completely paralyzed. If they cut interest rates to help the job market and get businesses moving again, they risk letting the energy and tariff inflation spiral totally out of control. But if they raise interest rates to fight the inflation, they risk breaking the low-fire equilibrium and triggering mass layoffs.
Which is exactly why the Fed's dot plot projections look the way they do.
Oh, the dot plot.
Yeah, the chart showing where each Fed official thinks interest rates are heading. Right now, 7 out of 19 participants are projecting 0 rate cuts for the entirety of 2026.
Wow.
They don't have the tools to fix a broken supply chain or a Middle Eastern conflict, so they just have to sit on their hands.
And that profound paralysis in the traditional public economy brings us directly to the second map in our overlapping reality.
Yes, the new world.
Here's where it gets really interesting. Because while the public economy is gridlocked by 1970s-style geopolitical oil shocks, the world's absolute biggest pools of capital are not just standing still in that game of musical chairs.
Not at all.
They are abandoning the public markets entirely and flooding into a massive private capital supercycle. They are essentially deciding to build the infrastructure of a sci-fi future in private.
The sheer contrast in scale and ambition is staggering. I mean, while traditional markets are obsessing over a 0.5% interest rate move, Silicon Valley just witnessed OpenAI close a $122 billion funding round.
That is just, I can't even fathom that number.
It gives OpenAI a post-money valuation of $852 billion.
Okay, let's clarify that term because 852 billion is an absurd number for a private company. What exactly is a post-money valuation?
It's quite simple, really. A pre-money valuation is what the company is agreed to be worth before a new round of investment.
Okay.
When investors agree to hand over that new cash, you add the new cash to the pre-money valuation to get the post-money valuation.
So it means the investors in the market fundamentally agree that the entity, fully funded, is worth just shy of $1 trillion.
Yes, nation-state level money.
And look at who's giving it to them. It's not traditional banks. It's coming from strategic partners who are building the underlying architecture of this new world alongside them. Amazon put in $50 billion. NVIDIA contributed $30 billion. SoftBank led with $30 billion. And for the first time ever, they allowed a $3 billion retail allocation through bank channels.
Yeah, so even regular investors are desperately trying to climb over the fence into this private market.
And the operational metrics behind OpenAI explain the frenzy. I mean, the company is generating $2.6 billion a month in revenue.
Supported by 900 million weekly active users on ChatGPT.
That's huge.
It is, but they are burning an estimated $38 billion this year alone to build their unified AI super app and to aggressively chase AGI, artificial general intelligence, by 2028.
And they aren't even the only one operating at this unimaginable scale. The sources note that Elon Musk just formally merged SpaceX and his AI company, xAI, into a single combined entity valued at $1.25 trillion.
It's massive.
And SpaceX has confidentially filed for an IPO targeting a raise of over $50 billion. If that happens, it would surpass Saudi Aramco as the largest initial public offering in the history of global finance.
And the logic behind merging a commercial rocket company with an artificial intelligence company is fascinating.
Why do it?
Because it reveals the absolute physical limits of this supercycle. The entire merger is predicated on the fact that AGI demands an unfathomable amount of electrical power and cooling.
Oh, because the terrestrial power grid on Earth literally cannot handle the compute requirements.
Correct. So their goal is the Terafab project. They plan to bypass terrestrial energy grids entirely by building massive, space-based data centers powered continuously by orbital solar satellites.
Wait, really? Space-based data centers?
Yes. They use SpaceX's Starship to launch the physical infrastructure and xAI to run compute.
Okay, I have to step in and push back on this massive tech euphoria because hearing these numbers, $122 billion funding rounds, trillion-dollar rocket mergers, it feels entirely detached from reality.
I know it's like science fiction.
It does, and OpenAI is bringing in impressive revenue, yes, but they are burning $38 billion in a single year.
Yep.
And looking closely at the funding breakdown, a massive chunk of this money isn't even liquid cash. It's incestuous tech trading.
Right, the compute credits.
Yeah. NVIDIA gives OpenAI $30 billion in GPU compute, not cash. How does that even work mechanically? Isn't this just a trillion-dollar house of cards waiting to spectacularly collapse?
If we connect this to the bigger picture, it makes sense, but it is a vital question. Let's break down the mechanics of those GPU credits, because it's a brilliant, if somewhat controversial, closed-loop system.
Okay.
If NVIDIA simply handed OpenAI $30 billion in cash, OpenAI could theoretically spend it anywhere. But by giving them $30 billion in compute credits, OpenAI is forced to use NVIDIA's servers and chips to run their models.
I see.
And in return, NVIDIA gets to book that usage as revenue on their own balance sheet.
Wait, so NVIDIA's revenue looks artificially massive, which boosts their stock price on the public market, which in turn gives them more financial leverage to issue more credits to AI companies.
Precisely. It is an entirely closed-loop economy.
Wow.
But the institutional players participating in this round understand that. They don't view this as a traditional software business. They view it as an infrastructure arms race. Furthermore, the actual capital being deployed is highly structured. It is milestone contingent.
Meaning they don't just hand over a blank check.
Exactly.
Oh.
Take Amazon's $50 billion commitment. The bulk of it, $35 billion, is locked up. It is strictly contingent on OpenAI either successfully reaching AGI or executing a public IPO by 2028.
Oh, wow.
So the investors are aggressively protecting their downside while forcing a frantic, unrelenting pace of development.
So it's a high-stakes, winner-take-all gamble.
It is. These tech giants and sovereign wealth funds believe that whoever builds the definitive AI and space infrastructure will fundamentally monopolize the next century of global economics.
Right.
If you can secure the foundational layer of AGI and space-based compute, burning $38 billion in a single year today is viewed as completely irrelevant. It is simply the cost of entry to become the landlord of the future economy.
The landlord of the future. That is a chilling but entirely plausible way to put it.
Yeah.
And it brings us perfectly back to the duality of the landscape we were looking at in April 2026. On one hand, you have a fragile, traditional public market that is reacting wildly to every single headline about oil shipments and short-covering technicals.
Stuck in the mud.
Exactly.
Yeah.
It's a world where the central bank is paralyzed by 3% inflation, and businesses are terrified to hire someone because of the next tariff announcement.
And completely superimposed over that, you have a sci-fi future being aggressively funded in the private sector at a multi-trillion-dollar scale, completely bypassing the gridlock of the old economy through closed-loop funding and milestone contracts.
And the reason this matters to you listening to this right now is that you are living your life directly on the fault line between these two colliding worlds.
Right.
You are feeling the immediate pinch of the old world when you pay $4 for a gallon of gas, or when you try to negotiate a raise in a low-hire job market and hit a brick wall because companies are standing still.
They aren't moving.
But at the exact same time, your retirement investments, the tools you use to do your job, and the long-term trajectory of your industry, they're being entirely reshaped by this massive private capital supercycle that is building the new world.
It is a profound transitional period, and transitions of this magnitude are inherently volatile. You have to understand both maps and navigate it.
Which leaves us with a final thought to mull over. As our terrestrial economies continue to struggle with international borders, supply chain bottlenecks, and the sheer physical limits of our energy grid, will the insatiable power and capital demands of artificial intelligence inevitably force the future of human infrastructure off-planet?
It's a huge question.
And if these massive corporate conglomerates like the SpaceX-AI merger successfully build that off-world infrastructure, will they effectively become more powerful and influential than the very governments trying to regulate them down here on Earth?
Honestly, they might.
It really makes you look at that economic map differently, because it turns out the map of the future might not be bound by the edges of the Earth at all.